We have, AOFI, which is a Bahrain-based Islamic standards forum. We can study and make reference to them. We have on the other extreme, we have seen in Malaysia, where it is all IFRS. There are no separates. All their accounting is done based on IFRS. So this is like another area where we are debating, discussing. Another focus of us has been that if there are any transactions that are happening in Pakistan and for which there is no clear-cut accounting guidance or standard is in field. So we are focusing on those. I can quote very recently. We have recommended to, and then the council has recommended to, has approved it, a formal communication to SSPs to be made. That is about IFRS 14, because IFRS 14, this is about the regulatory deferral account. Companies like Sui Southern, Sui Northern, K Electric, jahan rate regulation का concept है. For them, effectively, there is no formal standard. So IFRS 14 itself is a transition standard, and we have kind of debated, discussed, and engaged with those entities as well. And this is going to be recommended to SP very, very soon. And hopefully this will be made applicable. We are recommending, and the approval has been for 30th of June 2019 financial statements, because IFRS 14 is mainly disclosure-based standard. Another aspect is we regularly observe merger accounting, mergers ho rahe hote hain, so business combinations related under common control. So we are working on developing a guidance on that as well. So a number of aspects. I can stand up and I can stand here and speak for hours about the work that has been done. Accounting, as we all know, is an extensive area when it comes to impacting the business performance, because effectively accounting is nothing but reflecting what the business activities are being done and transforming those in a structured form of financial statements. So when the standards come, guidance is developed, and they affect the company's regular business, their performances, their bottom lines, their KPIs, then it becomes really important for the relevant companies to understand properly their impact. Lastly, in the end, I would like to thank all the members of the Accounting Standard Board, the forums that Saira mentioned, SSCB, State Bank of Pakistan, Ministry of Finance, Pakistan Stock Exchange, and academia. We have on our board Dean of IBA. So I would like to thank all of them. I also want to say a big thank you to the DTS team. Sohail Malik, he has been a pillar for us, writing many opinions, doing research. Previously, Saira Shamsi, she was also part of it. Now she has moved on to a different department, but we always approach her for many times to get support. And also in terms of the Accounting Standard Board, there's a structure, because these are very technical and sometimes becomes a very sensitive subject to give opinions. So we have established an advisory board as well for supporting the advisory group for supporting the Accounting Standard Board. There's a big thank you to them as well, because a very significant contribution and a real technical input come from them. And last but not the least, for arranging this program, SRC. Thank you.
Thank Thank you, Farooq Saab, for giving us an in-depth analysis of the projects that have been undertaken by the Accounting Standards Board and the developments that are happening relating to financial reporting. As we know that today's subject is supposed to be two standards mainly, IFRS 9 and IFRS 16. The first half is devoted to sharing about the developments relating to IFRS 9. And as Farooq Saab mentioned, this standard is applicable for periods ending on June 30th, 2019. So all the more we need to be aware of the challenges as well as how we need to be prepared for overcoming the implementation issues. We shall start off with a short video of IASP on IFRS 9 just to give you an overview of the standard.
In July 2014, we published our new financial instrument standard, IFRS 9, and it covers three different aspects of accounting for financial instruments. Firstly, how they're classified and measured. Secondly, how impairment or expected credit losses are accounted for. And thirdly, hedge accounting. Now, the first two parts of IFRS 9, classification and measurement, and impairment, were very much our response to the financial crisis. So, for example, on classification and measurement, we've changed the requirements in IFRS so that when an entity's credit risk increases, they don't book gains in profit or loss as a result. On impairment, we move from an incurred loss model to a more forward-looking expected credit loss model. Now, the third part of IFRS 9, hedge accounting, isn't really a direct response to the financial crisis, but what it does do is requires people to provide better information about their risk management activities, which helps them inform the users of their financial statements. In IFRS 9, we changed the accounting for impairment of financial instruments from a so-called incurred loss impairment model to an expected loss impairment model. Now, this is a really important part of our response to the financial crisis, because during the financial crisis, people raised concerns that the accounting for impairment resulted in booking loan losses and loan loss allowances too little, too late. So what IFRS 9 does in moving to an expected credit loss model is really two things. Firstly, right from when an entity lends money, it starts to account for its expected credit losses. It doesn't wait until an event happens before it does that. And secondly, when expected credit losses are measured, they are measured using all reasonable and supportable information that's available to the entity, which includes not just their historical loss experience and current information, but also their forward-looking expectations based on reasonable and supportable information. Now, during the financial crisis, people told us that there were circumstances when they expected losses to arise in the future, but they weren't able to take into account that forward-looking expectation. So IFRS 9 is very much designed to address that concern. The other part of the impairment model in IFRS 9, which is really almost as important as the measurement and recognition requirements, is the disclosures that come with it. So there's a lot more information provided to users of financial statements about the financial instruments that are showing credit risk that's what the entity would have expected when it lent money, and separately information about financial instruments that are performing worse than was anticipated by the company, and information about the sort of absolute credit quality of their financial instruments as at the reporting date. So the combination of the more forward-looking model and that richer set of information should enable people to much better understand the real credit loss expectations of reporting entities. So we published IFRS 9 some time ago now, back in July 2014, so over 18 months ago, and it's still only effective in 2018, so sometimes people think that seems like an awfully long time between when we finished our job and when people start to show the changes in their financial statements. But we made a very conscious decision allowing such a long lead time, and the reason for it is that we know that preparers, and particularly those in the banking and insurance industries, have got to make changes to their systems to put in place these new expected credit loss impairment requirements, which are a big change in accounting. So while it's been quiet for us for the last 18 months or so, for the preparers. They've been very busy, involved in their implementation and planning processes, and working with audit firms and prudential regulators to talk about the changes that they're putting in place to implement the new standard. Whenever we issue a new standard, particularly a major one, we're always interested in the implementation process that people are going through, and also whether any interpretation questions arise in implementation. So, as is always the case with the new standard, we've been involved in conferences and discussions and outreach activities, talking to people who are implementing IFRS 9, and particularly talking about the expected credit loss requirements, because they're such a big change in accounting. But what we did when we published IFRS 9 was, at the time we actually published, we announced that we were establishing an implementation group, a transition resource group as we call it, to help with the implementation of IFRS 9. And it was really because we knew that people were going to have to make big systems changes, and it was such a big change in mindset that we took this relatively unusual step. And what the transition resource group is and was is a group of experts in credit risk management who met in public to discuss questions that were submitted by people implementing IFRS 9 that we thought would help people understand the requirements of IFRS 9, give confirmation of what the requirements are, and also provide a forum where people listening could hear the types of approaches people in practice were taking to implement those requirements. So the ITG met 3 times in 2015 and covered a whole range of questions, which provided, I think, a lot of educational assistance for people, and we didn't actually identify any areas where we felt we needed to make changes to the standard itself, which was a good confirmation for us. Now, we don't plan at the moment to hold any more transition group meetings on impairment, but we do still have the group in place, and people can still submit questions if they have them through our website. So we stand ready, if you like, if people need help with the implementation process. So IFRS 9 sets out the expected credit loss requirements for financial instruments from a general purpose financial reporting perspective for entities that are applying IFRS. And that's separate to what the prudential regulators might require to be calculated for capital adequacy purposes. But we do have a very close relationship with the Basel Committee, and one thing that they have done is put in place some guidance on what they consider to be best practice for banks applying IFRS 9, what their expectations would be, particularly for internationally active banks, more sophisticated banks, when they're working out expected credit losses. And we often get asked whether we see that as a positive or not. And from our point of view, we see that as very much complementary to IFRS 9, so it really sets out their view on what's a good application of an expected credit loss model. The Enhanced Disclosure Task Force, which is a group that was established by the Financial Stability Board, have also done some work, and they've updated their recommendations on what would be good practice for disclosures in the context of an expected credit loss model. Again, that's not mandatory and it's not an IFRS requirement, but it's another set of information which is helpful for those applying IFRS 9 to look to as best practice, if you like, when they're thinking about what disclosures might help users of financial statements understand the expected credit loss requirements in IFRS 9. So in terms of looking forward, we've finished what we are going to publish on financial instruments for the moment in terms of IFRS 9, so there's a stable platform, if you like, for people implementing IFRS 9. Having said that, we're still interested in the implementation activities that people are undertaking, and if people did have extra questions, there's still the ability to submit them through our website. And as I said, the Transition Resource Group stands ready in case we need to use them. The other thing that's still happening on financial instruments is the work that our US counterparts, the Financial Accounting Standards Board, is undertaking. They recently published new requirements on classification and measurement, which importantly include own credit changes which are very similar to the ones that we've put into IFRS 9, again resulting in gains and losses not being recognised as a result of changes in an entity's own credit risk. And then we expect the FASB to publish a new impairment model shortly in the first half of 2016, which, like ours, is a move to a more forward-looking expected credit loss model with differences in detail to what's in IFRS 9, but a lot of commonalities, particularly in the information set that's used to measure expected credit losses.
Okay, with that debriefing, the format for the rest of the first half is such that we have 3 technical sessions on IFRS 9, and that will be followed by a panel discussion. A request is to all the audience to please note your questions, because instead of having a Q&A post each session, we'll take all the questions during the panel discussion. I hope that would be okay with all of you. As we've all noted that IFRS 9 replaces IAS 39. IAS 39 was like a patchwork of arbitrary bright line tests, accommodations, options, prevention measures with a single model that has only a few exceptions. As we learn about the classification and valuation of financial assets through Mohammad Zulfikar Akhtar, Mohammad Zulfikar Akhtar is member SRC and a senior partner at AFF with over 20 years diversified experience in advisory dealing with corporate taxation, mainly relating to transactions of business valuation, mergers, acquisition, restructuring, governance, and strategy. I would request Mr. Zulfikar to please come up on the stage and take us through the first technical session.
Thank you very much, Saira. Bismillahirrahmanirrahim. Mr. Session Chairman, my colleagues of SRC, my other colleague presenters, ladies and gentlemen, Assalamu alaikum. A very good morning to all of you. And being the incumbent CPD convener of SRC, I cannot stop myself from again formally welcoming you. It is something that I have to do at each seminar, so I thought I should do it now also, although I'm a presenter here. Very thanks to Farooq for explaining more than half of my presentation in the first introduction that he was giving. And as you would have noticed in the video, that Sue did not talk much about, rather anything about the classification and measurement and valuation. She was just interested about the impairment and all those models. So I'm thankful to her that she did not go through the rest of half of my presentation. Otherwise, I would have simply said welcome to you, and then I would have said that let's welcome the next presenter. So I would move directly to the classification and measurement side of IFRS 9. We all have been seeing over a period that a lot of standard setting has been changing from the externalities to the internalities of the business. You would recall when IFRS 8 had come, the operating segments, a lot of emphasis was on to how the management does what it does, how the management looks at the numbers, and a lot of internalities, inward seeing things were there, instead of the external sort of factors. So the external reporting was more and more aligned with whatever internal things were being done, or the way internally management was looking at the things. From that, almost every new standard which is coming, it gives quite a lot of emphasis onto the internal ways in which the management looks at its information and its operations. IFRS 9 classification and measurement is also primarily based on that instead of looking at the external variables to determine how should we classify and measure our financial assets, we should be looking at our internal ways, the way we manage the financial assets. So that is how IFRS 9 is also overall based. What we'll look at in this short presentation, which is still left after these speeches, we'll have a very short look about what is included or which financial assets are scoped into the financial assets IFRS 9 requirements. And we are very lucky to have a lot of familiar measurement categories the way they used to be in the predecessor accounting standards, primarily IAS 39. We'll quickly review that because that will be helpful when we move forward to the newer classification principles about how we classify our financial assets. In detail, we'll be looking at the business model tests and the contractual cash flow